Hey guys, Akil here. Welcome back to the Trading Coach Podcast. In today's episode, we're going to talk about two phases of major news reactions. And this is a timely podcast that I kind of snuck in here because this has been a pretty busy week when it comes to the most important fundamental announcements that are made in the market, which are going to be monetary policy interest rate decisions. On Wednesday, we had an interest rate cut here in the US. Today, on Thursday, we had a Bank of England interest rate decision. And sometime tonight, Thursday or Friday morning, depending on where you live, we have a Bank of Japan monetary policy report as well. And these are, like I mentioned before, the biggest impactful or most important news events that come in the market because they dictate many other things. And typically the market gets all excited, it sits on the edge of its seat waiting for a big move. And just like any other time, we did see a big move in the market. However, we then saw a correction, and a day later it was kind of like nothing happened. And in this podcast episode, I'm fielding a question from a trader in our live room session asking, why? What causes that? How come we saw a bunch of moving around and then kind of ended up in the same space? So if you're someone that was also curious about that and want to have a better understanding of how to deal and navigate high impact news events, then this is the podcast for you. Let's hop in. Thinking about market psychology, would the fact that not much movement happened be interpreted as overall indecision? Yes and no. So here's the thing. Remember I talked about how markets price in the news before it happens? And then yesterday I told you that there's two periods. There's the initial reaction, and then the next day usually we see either a correction or a continuation. Remember what the anticipation was, right? Even though, right, I'm going to show you, and this is the difference between paying attention to the street and the difference between paying attention to the street and and when I say street, the market, sorry, old school, thinking about Wall Street, and paying attention to the news, right? So you go back to yesterday's FOMC interest rate decision, right? What it said on Forex Factory, and probably like most economic calendars, I would guess, is it said that the forecast was a 25 basis point cut. But do you remember the conversations that we were having all during the week? Remember I showed you the Fed rate tool? 60+% thought it was going to be cut by 50. So this is the difference between paying attention, because you can look at, we ended up getting a 50 basis point cut. And you can look at Forex Factory and be like, it's all bright and red. And it's like, oh my gosh, right? The actual is much more than expected. But we actually cut by the amount that was expected, right? The market, 65% of the market, the last I checked, this was the day before, expected a cut of 50. And we got a cut of 50. So we got exactly what we expected. So there was no deviation, or very limited deviation from the expectation. So the market was already prepared for this cut. So of course we're going to see a lot of reaction when it initially comes out for two reasons. One, it's a big news event and like everyone wants to be involved and all crazy. To take kind of the conspiracy theory market manipulation side of things, if smart money wants to unload or add or get off positions, there's no better time to be sneaky than a major news event, because there's a lot of liquidity, so it's plenty of time for them to do what they want. But then the next day we came back up and the market realized, after it had time to interpret it, like, we didn't really do anything out of the norm. Maybe there's a little bit from Jerome Powell's speech, kind of talking about future guidance and the amount of rate cuts that we're going to have over the next year, or how aggressive we're going to be in November and what we're looking for, economic data, jobs, and all that stuff. But there really was no surprises. So the market did all this dancing, but it ended up like doing exactly what we thought it would do. It's kind of like, it reminds me of, again, insert normal Akil sports reference, right? It's kind of like a football team running all this motion before the play, and then just running the ball up the middle. Or like when Spain, not when they were good, they're a soccer team, but when Spain was bad before they were good again, right? Spain was really good with this style of football called, soccer, sorry. I'm shifting over slowly. Called tiki-taka, where they would just pass the ball around like 1,000 times, death by 1,000 cuts. And then they'd like score on you and you look like an idiot. But then Spain got bad and they would do all this tiki-taka stuff, where they passed it 1,000 times, but they would never actually score. And it was just like, okay, well, you did all this stuff, but you didn't actually do anything. So I think that's why we saw the lack of movement in the market. A little bit of it is also kind of what Bank of England came out with today. But overall, if you think about it in the terms I just told you, we actually didn't do anything different than what we expected to do. And the market had already priced in that expectation weeks, a month ahead of time. So we just did a lot of dancing and ended up right back to where we were. So again, it's really important to understand with major news events like this. There's typically two phases. The first phase is, let's break it down simple, two phases, day one, day two. Day one is the initial reaction. Day two is kind of the more thoughtful reaction. Again, going back to the argument thing where you have an argument with your significant other or someone on day one, and maybe you say some stuff that you regret, or you don't say stuff that you regret, but you're in the heat of the moment. And then day two, you kind of reflect on it. You're like, man, I probably shouldn't have said that. Maybe I should call and apologize, or I got to get something else off my chest. And you either continue with the argument or you apologize and make up for it after you have time to kind of think. When you're out of the heat of the moment, you can actually reflect in a better mind state. And that's exactly what the market's doing. So yes, that's a long-winded answer to basically say maybe not indecision, but nothing new. We were given minimal new information than what we already thought would happen. But a good example of why it's important to read those news, again, because you look on the economic calendar, you may think one thing. If you actually pay attention to what the market is thinking, you'll get more of a real feel for what the expectations are. Hope you enjoyed the episode. The recording comes from one of our live trading room sessions where we do a lot more than trading, right? We take a look at the markets each and every day, breaking down the technical opportunities, but we talk a lot about other important trading topics as well. My goal is to assist you in your development of becoming a consistently profitable trader. If you're ever interested in joining, we run them Tuesday, Wednesdays, and Thursdays, both a New York session and a London session. Just head over to www.tier1trading.com, sign up for that risk-free trial membership, and hop in for 2 weeks. All right, until next time, plan to trade your plan. See you next episode.